Hey, how's it going guys? Welcome back to the Module 2 of Technical Analysis Foundation, the complete professional trading course for beginners. Module 2 is all about chart reading basis. In this tutorial, we will go through the sub-module 2.3, talk about the concept of support and resistance, and how you can identify those significant support and resistance levels in any given market. Being able to identify support and resistance levels in any market structure is a very important skill to every professional trader. Not only it helps you to find the profitable trade setups, but also is an important tool for your risk management. But what exactly is a support and resistance, and how can we identify them? To understand support and resistance, first we need to understand one thing, which is called the pivot point, or some of the traders would rather call it the swing point. So basically, a pivot point is the basic unit of any given market. They can be categorized as pivot highs and the pivot lows, or some traders prefer to call them the swing highs and the swing lows. A pivot high or swing high is when a candlestick bar has a higher high than both of the previous bar and then the bar after. In the very short term, it represents the highest point or highest level where the buyers will not be able to push the price any further. On the other hand, a pivot low is exactly the same concept but inverted. It's a candle bar that has lower low than the bar before and the bar after. So in the very short term, the pivot low represents the lowest price level where the sellers were not able to push the price any lower. Let's take a look at what pivot points can do for our technical analysis. So here's the daily chart of Bitcoin. To help you see those pivot points, I'm using these green dots to highlight them so that you can see them easier in the chart. In this chart, we're going to highlight those pivot lows or the swing lows and see what happens when we connect these pivot lows together. So there you go. If we connect all these pivot lows and form a straight line, we can notice that there are a lot of price actions around this line. Whenever the price touches this line, it will bounce back and go higher. This is what we call a potential support line. And connecting multiple pivot lows or swing lows together is a common way to find the potential support line in a market. One of the key benefits for us to study about this support level is to help us identify those high quality breakout trade setups in the future. For example, in this chart, when Bitcoin breaks through the support line and close below it with a very high volume, it gives traders a potential good entry point for a short position to bet against Bitcoin. As you can see, the price goes lower once the price breaks down the support line. Let's take a look at another example. This is a daily chart of gold price. As you can see, there are 4 obvious pivot highs in this chart, so I use the red dots to mark them. A little difference from the previous example is that in this chart, the market is making lower pivot highs or lower swing highs. Each swing high is lower than the previous one. If we connect 3 or 4 pivot highs together and form a straight line, we can notice that whenever the price approach and hit this line, it will go back down lower. This is what we call a resistance line. And connecting multiple pivot highs or the swing highs together is a common way to help us find a potential resistance line in the market structure. Similar to the support line, a resistance line can also help the traders to identify the great breakout trade setups. If you don't understand what a breakout is, it's totally fine. In the module 3, I will share with you guys more details on how exactly you can trade breakouts. So how do we identify support? A support is a price level at which a sufficient amount of demand is coming to the market and potentially stop a downtrend and a bounce back. Basically, you can understand a support line is a demand line. It's where a lot of buyers are waiting there to buy and it creates a strong buying power. Remember, we mentioned before that we need to always see the market as a result of the imbalance between buying power and the selling pressure. As price declines, lower price will attract more waiting buyers. At a certain level, price becomes low enough that buyers are willing to take up all the sell orders in the market and create a significant imbalance between buying and selling pressure in the market at that price level. So the price will feel like a catching by a floor at this level and start going back higher. Many professional traders use support level to help them identify ideal entry point, stop loss, and even profit targets based on their strategies. If we talk about support, then there is one type of supports that we have to highlight here. It's called the uptrend support. In the uptrending market, so the market, the price are trending up, making higher highs and higher lows. An uptrend support, or also known as uptrend line, is the support line of this uptrending market. Normally, by connecting three higher swing lows in an uptrending market, you can form an uptrend line. If the market is in an uptrend, we mainly focus on the support line, not the resistance line. You probably heard about the trend line before. In terms of the definition and the function, a trend line is a special type of support or resistance line that works in a special type of market environment, the trending market. Trend lines are often used by the professional traders, especially the trend followers, to visualize and analyze the trending market structures. And then what is a resistance line in the market? A resistance is a price level where a great amount of sellers are waiting there and putting their sell orders at that level in the market. As a result, the market fails to push the price higher and it goes back down. We can understand a resistance line is like a supply line, where all the sellers are waiting there to sell at that certain price levels, which produce a lot of supplies in the market. As the price goes up, higher price will attract more willing sellers. So at some certain level, price increases high enough that most of the sellers are willing to soak up all the buying order in the market and create a significant imbalance between the buying and the selling pressure. So the selling pressure is really high at this level, and the price just feel like they're hitting a ceiling and then retrace back lower. Similar to the support, professional traders often use the resistance levels to help them identify the ideal entry points, stop loss levels, and even profit target levels as well. If we talk about the trend line in the uptrending market, then we have to talk about how the trend line works in the downtrend market too. In the downtrend market, which is the market making lower highs and lower lows, so a downtrend line is the resistance line of the downtrend market. In the downtrend market, the price are making lower highs and lower lows. If you connect the three lower highs in the market, form a straight line, and cross as many swing highs as possible, you will get a downtrend line, or the downtrend resistance of the market. It's opposite to the uptrend market. In the downtrend market, we mainly focus on the resistance line. We'll have an entire module, module 3.2, to talk about the trending market. In that module, you will learn much more details on how exactly you can analyze any trending market. Alright guys, let's take a look at some real example. I'm going to show you some real demo. So here is a weekly chart of S&P 500. I'm going to use this chart to show you guys how you can find a support or resistance level in this chart. So when you see this chart, that's obviously that was an uptrend. So the price going up. However, if you realize that if you notice that at this level, there's a lot of price actions going on around here. So that's obviously you feel like there's a ceiling around here that the price want to push up, but whenever they touch around this area, and the price will come back down, and then touch it, come back down. So this is the potential place that you can find a solid resistance level. Then how you can draw it in this chart. So I'm on a trading view, which is the charting system I always use, which I highly recommended. And so what you're gonna do is that you come here. There is a function called trend line. So you're gonna use the trend line to draw a horizontal line. So something like this. You have to make sure it's horizontal. All right. So once you draw around the same length of this period, and then what you're gonna do the next is that you're gonna make sure it cross as many touches of the upper shadow as possible. For example, like this. All right. So once you draw this line on this chart, you're gonna see it very clearly that it will act as a resistance for the previous uptrend. So as you can see, there's an uptrend going up. Once they hit this resistance, and the price will come down. It feels like the price hit the ceiling, it cannot go up, and then look at here, the price even drop, then it bounce back much lower, and then try to break it, and fail, and come back, and try to break it, fail. So there's a lot of a lot of price action going on right on this chart at this resistance level. All right, so the next in later on during this module, what I'm gonna share with you is that once the resistance level break it, and then this resistance level will become and will act as a support level. For example, right here, when the price break the resistance level and close above the resistance level, let me zoom in, and close above the resistance level, and when the price come down, then this resistance level is gonna act like a floor, so to catch the price. So when the price try to come down, and the price will bounce back higher, and come down and then bounce back higher, and then once they test it twice, and then the uptrend continues. So like this. So later on, I'm gonna share with you what is the reason behind this situation. What is the reason that when the resistance level, once they break it, it will become a support level. All right, so let's move on. All right, so let's move on, and we're gonna learn a very important rule of support and resistance, which is once the resistance level is violated, it will become a potential support. It works the other way too. When a support level is violated, it will become a potential resistance. You may wonder, what is the reason behind it? So let me explain. Traders enter the short position at the previous resistance level, for example, the point A in the chart, and anticipate the price will bounce lower from the resistance. However, the price breaks through the resistance and goes higher. Those short sellers at point A will have losses on their short positions. When the price comes back to the same level, for example, the point B in the chart, these short sellers will be at the break-even level. So they are more willing to cover their short positions by buying them back. Therefore, the previous selling pressure now turns into the buying power at the same level. This imbalance swing from the high selling pressure to high buying pressure turned the previous resistance level into a potential support level. If you're a new trader, I highly recommend you to pay more attention to these transitions between support and resistance, because this could be one of the biggest game changer to improve your trading results. So here are some of the quick tips on how to draw a better support or resistance line in a chart as a beginner trader. To be more reliable, support and resistance lines should at least connect the 3 pivot points. When you are trying to decide which pivot points to connect, put more priorities on the most recent pivot points. Aim to get as many shadow touches as possible without cutting off too many candlestick real bodies. Never force a support or resistance line in the market. In general, the best ones are always the most obvious ones. Sometimes there could be too much noise in the market when you are analyzing on a lower time frame. So don't forget about switching to a higher time frame. It will help you cut off those market noises and focus on more clear market structure. Cool, after going through some of the tips on how you can draw the support and resistance in the market, now I'm summarizing some of the useful tips on how you can find simple trade setups by using support and resistance. Basically, there are 2 potential scenarios at a support and resistance level. One scenario is test and then bounce back with confirmation. And the other scenario is break through the support or resistance level with strong momentum. Each scenario will have its own potential trade setups. For example, let's take a look at the support first. When the price tests the support and the bounce back from the support going higher, you should look for potential long trade setups. However, when the price breaks through the support level with a high volume and a strong momentum, it could be a potential breakdown, and then you should look for short trade setups. Now let's take a look at the resistance. If the price tests the resistance level and then retraces back to lower price, it could be a great short opportunity. On the other hand, if the price breaks through the resistance with high volume and a strong momentum, then it could be a potential market breakout, and then you should look for long trade setups. So these are the 4 tips on how you can find the high quality trade setups with support and resistance. Of course, in the real market, it can be way much more complicated than our expectations. Making decisions purely rely on support and resistance alone may not be sufficient sometimes. That's why in the coming modules, we will teach you more techniques that you can combine with support and resistance to find your trading edge in the market. But remember, being able to identify support and resistance levels in the market is the most fundamental and important skill that every beginner trader must have. Alright, before we wrap up, there's a fascinating ancient Chinese quote I would like to share with you guys that I found is amazingly relatable to our trading. It goes, "The unmoved is the source of all movement." In any given market, there are always some periods where the price seems to stay quiet and not going anywhere. They tend to stay around the same support or resistance level and barely move with small volume. In technical analysis, we call them the market consolidations. This is where you should pay close attention to because during this consolidation period, the market is potentially accumulating massive energy for the next big breakout movement. Cool, now we come to the end of the module 2.3. I hope you guys enjoy it. Again, thanks so much for watching, and I will see you guys in the module 2.4. Bye for now.